Hello again, students. This is Professor Stephen Atchley, and today we take up Chapter 3 by studying the learning objectives and giving a quick summary. And then, after we've summarized that section, we will compare the differences between the U.S. and international standards. Our first goal is to explain the importance and prevalence of judgment in the financial reporting process. Judgment, of course, is defined as the process by which a decision is reached in situations where there are multiple alternatives. Managers make their judgments in financial reporting, including things like whether to report a business event, and if so, how and when, or what is the appropriate financial reporting treatment of a transaction, or number 3, what amount should be reported in the financial statements. In this regard, both the IFRS and the US GAAP are quite similar, and the book makes no note of any particular differences. Our second learning objective in this chapter is to discuss the role of accountants' assumptions and estimates and the related disclosures in the financial reporting process. Managers must make assumptions and estimates in selecting accounting methods and applying accounting standards. This is because we have a principles-based rather than a rules-based approach to the subject. Companies report details about the accounting policies they use in one of the footnotes to the financial statements. The IFRS further requires that companies disclose additional information about the assumptions and estimates they make at the end of the accounting or reporting period, far more extensive than that required by the U.S. This is one of the areas of difference which is currently inactive and not being updated. Learning objective number 3 is to identify obstacles to the use of sound judgment in preparing the financial information and ways of overcoming them. There are a number of obstacles and potential impediments to the use of good judgment. We will go through a number of these here briefly. First of all, factors that may influence judgment to intentionally bias their estimates. Naturally, managers have their own interest. It should be subordinate to that of the shareholders, but obviously that is not always the case. Secondly, there may be cognitive biases. Cognitive bias simply means that the thinking has gone on before the judgment or before the decision making, and one has already discarded a number of possibilities in one's thinking. Thirdly, an increase in complexity of the business environment and business transactions makes it difficult to exercise judgment. To minimize cognitive bias, auditors exercise professional skepticism, which is, quote, an attitude that includes a questioning mind and a critical assessment of audit evidence. This is one of the most important functions auditors provide, is that critical view of the information that management may lack. Cognitive biases that impact the way accountants make judgment include the following. Availability biases. It's often the correct information for making the decision is not available, and so any decision that is readily available is used in its place. This obviously creates a bias. Secondly would be a bias of overconfidence. This is particularly common in upper management. Confirmatory bias. That is, there is no one to confirm what's going on. They're just simply the one group making all the calls. Groupthink is similar in that regard. Groupthink means that one or a few of the group lead the conversation and the others passively go along with whatever decisions are made instead of exercising independent judgment and critical thinking. We also note their anchoring bias, which is defined for you in the chapter. Techniques to overcome these biases include, number 1, Becoming organized and methodical in the decision-making process, taking notes, step by step, following an established process or routine. Number 2, generating alternatives even when you think you have already arrived at correct answers. Sometimes it pays to look a little deeper into the subject, and it'll become evident that the original answer may not have been sufficient. Documenting your rationale about the alternatives. Write down the reasons why you chose what you chose and why you discarded what you discarded. Finally, delaying your final judgment until you are certain that you've examined all of the pertinent information, gathered all of the facts, and have covered all of the alternatives. Naturally, it's not possible to cover everything, but be sure that you've done a thorough job before making the decision. If it's possible to delay it, that is helpful. Learning objective number 4 is to describe the types of authoritative literature and the hierarchy of that literature, the importance of it from 1, 2, and 3 levels. The Financial Accounting Standards Board's Accounting Standards Codification, which is abbreviated FASB-ASC, is that document or that body of information that contains the authoritative USGAAP literature. The USGAAP literature has 3 levels of authority. The first are the codifications and the SEC rules and interpretive releases. While the codification applies to all entities that report under the U.S. Generally Accepted Accounting Procedures, the SEC materials apply only to publicly traded entities and registrants. Just below the codifications and SEC rules, we have level 2, the authoritative rules and principles for similar transactions. If you can't identify the exact transaction, then a similar transaction is the next level of authority. And finally, level 3, other materials, including things like the Financial Accounting Standards Board's concepts and concept statements, the IFRS, industry practice, and textbooks. And finally, textbooks are the final authority, the lowest level of authority. The IFRS literature is a little bit different here, and it will take us just a brief moment here to note some of the differences. The reporting standards, International Financial Reporting Standards, are what we're referring to. They generate what are called International Accounting Standards, IAS. They also issue interpretations and committee interpretations. IFRIC would be the committee interpretations. The Standing Interpretations Committee interprets items, and that committee is always meeting in session with regular results. The hierarchy of information has 4 levels as opposed to the 3 that we find in the U.S. Level number 1, the IFRS standards and interpretations that specifically apply to a transaction, an event, or a condition. If you can find it in the literature as it occurred, that would be level 1. Level 2 means authoritative rules for a similar transaction are all that you can find, and that would apply. Level 3, the framework definitions, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses. If you can't find it in the written standards, it will then appear somewhere in the principles, and we apply them as appropriate. And finally, level 4, the least authoritative, recent pronouncements of other standard-setting bodies that use a similar conceptual framework to develop accounting standards, other accounting literature, and acceptable industry practices to the extent that they do not conflict with sources in levels 1 and 2. When moving to levels 2 and 3, the IFRS addresses the need for management to use judgment in developing and applying accounting policies. Clearly, since the IFRS and the FASB standards are being developed continually and are not yet fully fleshed out, we can't always find level 1 or 2 authoritative sources, and so are forced to fall back on other items. And finally, the learning goal number 5 is to outline and apply the steps in the financial accounting research process. How is that done? The steps are 6 in number, and when the appropriate financial reporting treatment for a business transaction is unclear, accountants must then engage in research. That means they look to the literature and develop a recommended accounting treatment for the item which is under question. This is probably the most important aspect of accounting practice and accounting advice giving. Researching the alternative investigation, or a research is a systematic, say that 3 times fast, investigation into an issue. There are 6 steps involved in this investigation. Step number 1, establish and understand the facts. That would include stating the problem clearly. Number 2, identify the issue. What is the research question specifically? And number 3, search the authoritative literature that's available. That would be the accounting standards as promulgated, or level 2 or level 3 sources as mentioned earlier. Step number 4 is to evaluate the results of the research. Here again, it pays to be methodical and to write your reasons for accepting or rejecting particular alternatives. Number 5, develop your conclusions. And number 6, communicate the results of the research to the interested parties. Again, the US GAAP and IFRS standards and approach to decision making are identical, and there's no need to make note of individual differences. Okay, this should give you a brief summary of a really interesting chapter, and there's no substitute for looking into the literature, so that's what most of our exercises in this section will involve. Thank you very much, and we'll see you next week for Chapter 4.